Welcome to the Deep Dive, your go-to for cutting through the noise. We sift through the data to help you understand what's really driving things.
And today, we're diving into Ashland Inc.'s third quarter fiscal 2025 earnings call. This wasn't just about the numbers, it felt like a real statement about where the company is heading.
That's right. Some of those headline figures, they might look a bit off at first glance.
Yeah, definitely raised an eyebrow or two.
But the market reaction tells a different story, doesn't it? So we're going to unpack the strategy, the efficiencies, the future catalysts management talked about, give you the full picture on Ashland. Okay, let's kick things off with a quick look at the core financial results for Q3. So the company reported a GAAP EPS loss of $16.21.
Well,
yeah, but hold on. Before that number scares anyone, it's really crucial to know this was mostly driven by a huge non-cash goodwill impairment. $706 million.
Right, so that's an accounting thing, not cash actually leaving the building.
Exactly. It's writing down the value of old deals on paper.
Okay, so stripping that out, what did the ongoing business look like?
Well, the non-GAAP EPS, that came in at $1.04, which did fall short of the $1.24 consensus.
Okay, a miss there. And revenue?
Revenue was $463 million, also missed estimates, and it was down about 15% year over year.
Okay, so misses on non-GAAP EPS and revenue.
But, and this is a big but, the story changes when you look at cash. Ashland posted really strong free cash flow, about $108 million.
$108 million.
And almost 100% free cash flow conversion. That means nearly every dollar of adjusted earnings turned into actual cash.
Now that's impressive. That kind of conversion shows really tight management.
Absolutely. And they've got over $800 million in liquidity, so lots of financial flexibility.
So that strong cash performance, and you mentioned resilient margins too, despite the lower volumes, that's likely what the market focused on.
Precisely. It helps explain that more constructive view overriding the headline misses.
Makes sense. Quality of earnings, really.
Okay, let's unpack this more. Get into the strategy. Management said their portfolio optimization is complete.
Right. They've been working on this for a while, shedding lower margin stuff.
Yeah, intentionally cutting sales by about $53 million this quarter alone.
Yeah.
Divesting things like nutraceuticals, their AOA business.
Adhesives, right.
Right. Since fiscal 2019, they've streamlined things, improved quality, cut net tangible assets by over $300 million. It's been a long process.
And the CEO's message was strong. The reset is over. That signals a shift, right? Away from cutting towards growth from this leaner core.
It definitely implies the headwinds from those divestitures should be mostly behind them now.
Yeah, though, saying the reset is over, but capitalizing on that reset, that's the next challenge. Execution risk is real.
Fair point. Growth doesn't just happen automatically after you trim down.
Exactly. The market seems to be betting on it, but turning that corner, actually accelerating growth and innovation from the new base, that takes time.
Okay, another big piece, and this one seems pretty concrete, is the $60 million manufacturing network optimization.
Yes, the plant consolidation.
They confirmed they finished the HCC network consolidation, moving production from Parlin, New Jersey to Hopewell, Virginia.
HC being hydroxyethyl cellulose, key ingredient.
Right, and the whole program, plus other restructuring, is actually running ahead of schedule.
Okay, operationally good news, but how do those savings actually hit the P&L? That's always the question.
Good question. Management clarified that. So the HCC consolidation work is done operationally, but the financial benefit, it's capitalized into inventory first.
So it bleeds through as they sell that inventory, not an immediate hit.
Exactly, like a pipeline, as you said. They expect about $20 million in savings this fiscal year from the broader restructuring.
Okay.
Plus another $12 million carrying over into fiscal 26, mostly in the first half.
And the HC-specific savings.
That's the big one for next year. They anticipate a really meaningful step up. Get this, $55 million still to be recognized from that HC move.
Wow, $55 million. That's a significant tailwind baked in for next year. That definitely supports the reset is over, now focus on earnings powers narrative.
It really does. So, okay, big picture strategy is clear. How did this play out in the different business segments? Let's start with life sciences. Still the star performer.
Seems like it, despite a 17% reported sales decline.
Which was mostly that portfolio optimization we talked about.
Right. Organic sales were only down 1%, and pharma volumes actually grew 4%.
Yeah. And they delivered a record-adjusted EBITDA margin, 33% for the second quarter in a row. That's huge profitability.
33% margin. In this environment, that really highlights the value of their pharma offerings and good cost control, obviously.
It really underscores that segment's quality, even with all the portfolio changes.
It feels like the bedrock of the company right now. Stable cash, strong margins.
Does that maybe hint, long term that they might double down even more on pharma? Maybe more deals or divestments around that core?
It's a great question. They haven't explicitly said that, but the numbers make a compelling case, don't they? That kind of performance gives them options, flexibility.
True. Okay, moving to personal care. Organic sales down 6%.
Yeah, they mentioned some specific customer weaknesses, plus tough comparisons to last year.
But they did highlight strong sequential growth in biofunctional actives.
Anti-aging, hydration ingredients.
And microbial protection, basically preservatives. So maybe signs of an early recovery in spots.
Possibly. They did hit their margin target, high 20s EBITDA margin for the year, so profitability held up okay.
They did note some variability within personal care, though.
Right. Mass brands seem stable, but the prestige end, especially for those biofunctional actives, saw some shifts, maybe high-end consumers pulling back a bit.
So they're expanding geographically, diversifying customers to kind of spread that risk. Smart move.
Definitely. Don't want to be too reliant on one channel or region.
Then specialty additives. Kind of a mixed bag here. Organic sales and volumes, both down 11%.
Ouch. Weak architectural coatings season, so paint demand was soft. And ongoing pressure in China.
But they did see growth in performance specialties and energy markets, gaining some share there, it seems.
Yeah, and their China strategy is interesting, despite the current weakness. Overcapacity, soft demand. They're not pulling out.
They see it as long-term strategic.
Right. They have a cost-effective plant there. They're rebalancing, even exporting from China to other places to manage things.
And they see some segments emerging in China that actually value innovation, high quality.
Yeah.
Which is Ashland's strength.
It shows they're playing the long game there, not just reacting to the current cycle.
Okay. And intermediates.
Yeah.
Still navigating tough supply demand, especially in Europe.
Yeah, that's been a challenging market.
But what caught my eye was the benefit from advanced manufacturing tax credits.
Ah, the tax credits. How much of those were?
Estimated $5-6 million a year, expected through at least 2029, phasing out by 2033.
That's a nice little buffer. $5-6 million annually isn't trivial. Helps offset some of that market pressure.
Yeah, it's like a predictable income stream, cushioning things a bit.
Shows they're smart about leveraging those kinds of incentives, too.
Definitely. Okay, shifting gears, slightly innovation, another bright spot.
How so?
They're actually ahead of plan. Already hit $10 million in innovation-driven sales. That met their full-year target with a whole quarter left.
Wow, hitting the full-year target in Q3? That's strong. Especially in specialties, innovation is key.
Exactly. Driven by core platforms, especially in pharma.
Yeah.
Things like injectables, tablet coatings, central to their growth plan, showing good sequential growth.
That's crucial. You need that new product pipeline to drive margin accretive growth long term. Hitting targets early is a great sign their R&D is working.
And one more note on leadership. William C. Whitaker is officially the new CFO, started July 18th. This was his first earnings call.
Right, new CFO on board. Always interesting to get their perspective.
So looking ahead, guidance. They narrowed the full year fiscal 25 range.
What are the new numbers?
Sales now expected between $1.825 billion and $1.85 billion. Adjusted EBITDA between $400 million and $410 million.
Okay, so tightening the range. Anchored more towards the lower end, it sounds like.
Yeah, reflects a prudent stance. Given that demand is still kind of muted, mixed patterns across the business, seems realistic.
Makes sense. Better to be cautious. What about inputs, raw materials, pricing?
Raw mats are holding steady. Pricing pressures seem to be easing a bit. And tariffs, they're watching, but don't expect the material hit in fiscal 25.
Okay, so some stability there at least.
So pulling it all together for the investor perspective, what does this mean? You had headline misses on non-GAAP EPS and revenue.
Which usually sends a stock down.
Right, but Ashland stock reacted positively. Closed up 5.6% on call day, big volume. And it kept outperforming the materials ETF over the next 1 and 3 months.
Fascinating. That really speaks volumes, doesn't it?
It does. That disconnect is key.
It points to that cautious, constructive view we talked about. Investors looked past the noisy headline numbers.
And focused on
the strong free cash flow, the resilient margins, the disciplined strategy like finishing the portfolio pruning. They saw the quality underneath.
And that big goodwill charge, they understood it was non-cash. Accounting, not operations.
Exactly. Management's communication there was effective. And that narrative, Reset is over, huge cost savings coming, innovation progress. That resonated.
Suggests the market is buying into the potential for long-term value from this leaner, more efficient Ashland.
It seems like it. They're starting to price in those future savings and the improved focus.
All right, time for our This Is Not Financial Advice segment, where we throw out a plausible, if maybe a bit edgy, trade idea. Think hedge fund brainstorm.
And let me just say again, purely for entertainment and discussion, do your own homework, folks.
Okay, so Ashland says reset is over. Big savings are coming online. Cash conversion is fantastic. The market initially doubted, then warmed up. Here's the play, maybe a bit unconventional.
Lay it on me.
You go long Ashland, ASH equity, obviously. But here's the twist. You also go long select customers of Ashland's Life Sciences segment.
Interesting. Which customers?
Think smaller, innovative pharma or biotech companies. The ones really relying on Ashland's specialized stuff, those advanced injectables, coatings, the high-tech ingredients.
Okay, so betting on Ashland and their key innovative partners. What's the thesis?
The thesis is Ashland's self-help, those $55 million in savings still coming, the $12 million carryover gives them a hidden earnings floor and a competitive edge lots of peers lack. That helps them weather any downturn.
Right, the internal catalysts.
But the real kicker, the alpha, comes from recognizing that Ashland's premium ingredients are enabling innovation elsewhere. So by going long their cutting-edge customers too, you're betting on Ashland's efficiency and their ecosystem leadership.
So it's a bet on Ashland's indispensable role in the high-value pharma chain.
Exactly. You're leveraging their success and the success they enable in drug discovery. It's a double dip on specialized chemistry and pharma innovation's future, betting on the supplier and the innovators they empower.
That's definitely an interesting angle, playing the ecosystem, not just the single stock. Audacious, plausible. I like it for a thought experiment.
So let's recap Ashland's Q3 FY25. Really, it was a quarter defined by strategic execution, wasn't it?
Absolutely. Despite those headline misses, the underlying story was strong free cash flow, resilient margins.
Driven by finishing that big portfolio optimization and pushing ahead with the manufacturing efficiencies.
Yeah, management painted a clear picture. More focused, more agile Ashland, positioned for margin growth through innovation and smart capital use.
And it seems the market is finally starting to look past the short-term noise and underwrite that cash and margin story.
The appears so.
Which leaves us with a question for you, our listener. How will these kinds of strategic shifts, optimizing manufacturing, pruning portfolios, change the game in specialty chemicals? What does competitive advantage look like now?
Definitely something to think about. And thank you for tuning into the deep dive. Just a reminder, this is for educational purposes, not financial advice.
We always appreciate you listening. Join us next time for another deep dive into the numbers and narratives that shape the market.